Imagine you're an investment bank looking to manage risk and generate profit. A credit default swap, or CDS, is a powerful tool in your arsenal. It's like buying insurance on a loan or bond. If the borrower defaults, you get compensated. That's the essence of a CDS. A CDS is a financial agreement that acts like insurance against the default of a borrower. Typically, this borrower is a company or a government. The buyer of the CDS, often an investment bank, makes regular payments to the seller, like insurance premiums. In return, the seller promises to compensate the buyer if the underlying borrower defaults on their debt. This default could be anything from not paying interest on a bond to declaring bankruptcy. Essentially, a CDS allows investment banks to shift credit risk from one party to another without necessarily owning the underlying debt. It's a complex but crucial tool for risk management and profit generation in today's financial landscape. Imagine an investment bank. Bank B is concerned about the credit risk of its bond portfolio. Bank B is wary about the possibility of some companies defaulting on their bond payments. To hedge against this risk, Bank B decides to buy a CDS from another financial institution, say Institution C. Institution C agrees to sell the CDS to Bank B for, let's say, 1% of the bond's value per year. Bank B makes these regular payments to Institution C. If the companies in Bank B's bond portfolio repay their bonds successfully, Institution C keeps the premiums, and Bank B's risk is mitigated. However, if any company defaults on its bond payments, Institution C steps in. Institution C will have to pay Bank B the remaining value of the defaulted bonds. In this way, Bank B uses the CDS to hedge against credit risk, transferring the risk to Institution C. From an investment bank's perspective, the CDS market is a dynamic environment with several crucial players. Let's explore the key participants. First, we have the investors, who are often looking to protect their portfolios from potential defaults. These investors could be hedge funds, pension funds, or even other banks. Investment banks like ours often act as protection sellers, taking on credit risk in exchange for premiums. We use advanced models to price the risk and manage our exposure effectively. Regulators play a vital role in this market, ensuring that all participants adhere to the rules and maintain market stability. They monitor market activities and enforce regulations to prevent systemic risks. The reference entity, whose creditworthiness is being ensured, could be a company, a government, or a specific bond issue. Finally, brokers act as intermediaries, connecting buyers and sellers and facilitating smooth transactions. They are essential for providing liquidity and ensuring the flow of information in the market. Despite their complexity, CDS offers several potential benefits for investment banks. For starters, they allow investment banks to manage risk more effectively. By buying CDS, banks can hedge their exposure to specific companies or even entire sectors. CDS also enhance market liquidity, which is crucial for investment banks. Since they allow banks to trade credit risk separately from the underlying debt, they create a more efficient market for both bonds and credit protection. Moreover, by providing a way to price and trade credit risk, CDS can contribute to market stability. They also offer profit opportunities by allowing banks to take positions on the creditworthiness of borrowers, which can lead to significant gains. Finally, CDS provide valuable information about the perceived creditworthiness of borrowers, helping investment banks make more informed decisions. Section 5. The downside of CDS risks and dangers from an investment bank's perspective. However, like any financial instrument, CDS come with their own set of risks. One significant concern is their complexity. CDS contracts can be difficult to understand and value, even for investment banks. Another risk is counterparty risk. This is the risk that the seller of the CDS, the one who promises to pay in case of default, might not be able to fulfill their obligation. This was a major issue during the 2008 crisis. Furthermore, CDS can be used for speculative purposes, where investors bet on the likelihood of a default rather than hedging existing exposure. This can amplify market swings and create systemic risks, as we will see later. Investment banks also face potential financial losses if the CDS market turns against them. Additionally, there is the risk of increased regulatory scrutiny, which can lead to tighter controls and higher compliance costs. Regulatory bodies may investigate and impose penalties if they find any misconduct or excessive risk-taking. Section 6. CDS and the 2008 financial crisis, a cautionary tale. The 2008 financial crisis exposed the dark side of CDS. The crisis was fueled by the misuse of CDS on mortgage-backed securities. These securities, which bundled thousands of mortgages, were considered safe. However, as housing prices started to fall, defaults on mortgages surged. This triggered massive payouts on CDS linked to these securities. Many CDS sellers lacking sufficient capital were unable to meet their obligations, leading to a cascade of failures. The collapse of Lehman Brothers, a major CDS seller, sent shockwaves through the financial system. The crisis demonstrated how interconnectedness and lack of transparency in the CDS market could amplify risks and trigger a global meltdown. From the perspective of an investment bank, several lessons were learned. First, robust risk management practices are essential. Transparent reporting and monitoring systems must be in place to track exposure. Diversification of investments can mitigate potential losses. Finally, adhering to ethical trading practices ensures long-term stability and trust in the financial system. Section 7. Taming the Beast Regulation After the Crisis. The 2008 crisis was a wake-up call for investment banks worldwide. They realized the urgent need to reform the CDS market and prevent future crises. Since then, significant steps have been taken to mitigate the systemic risks posed by CDS. One key reform was the introduction of central clearinghouses for CDS trades. These institutions act as intermediaries between buyers and sellers, guaranteeing the settlement of trades even if one party defaults. Regulators also implemented stricter capital requirements for investment banks that deal in CDS. This ensures that they have sufficient buffers to absorb losses and reduces the risk of a domino effect in case of defaults. Furthermore, regulators have pushed for greater transparency in the CDS market. This includes reporting requirements for CDS trades and the establishment of data repositories to monitor market activity and identify potential risks. Section 8. The Future of CDS, a Balancing Act. The CDS market has come a long way since the 2008 crisis. Increased regulation has undoubtedly made the market safer and more transparent. For investment banks, CDS remain complex instruments with inherent risks. Looking ahead, the future of the CDS market will likely be shaped by a delicate balancing act. On the one hand, investment banks must ensure that CDS are used responsibly to manage risk without posing systemic threats. On the other hand, it's crucial to recognize that CDS can play a legitimate role in financial markets. They can help banks manage risk, enhance market liquidity, and provide valuable information about creditworthiness. Investment banks also use CDS to maximize returns by strategically managing credit exposure. New types of CDS contracts tailored to specific risks and asset classes may emerge. The challenge will be to harness this innovation while maintaining market integrity and investor protection. Section 9. Conclusion. CDS, a tool, not a toy. Credit default swaps, like any powerful tool, must be handled with responsibility and expertise. From the perspective of an investment bank, they are essential instruments for managing risk and enhancing market efficiency. However, if misused, they can become dangerous weapons of financial destruction. The 2008 crisis highlighted the dire consequences of reckless and unregulated use of CDS. Regulatory reforms since then have significantly mitigated these risks. Investment banks must remain vigilant and committed to responsible usage and risk management. As the CDS market evolves, it is crucial for all stakeholders to ensure it remains a tool for financial stability, not a source of future crises.